Canadian bond markets are flashing warning signs about explosive inflation ahead, with the 2-year government bond spiking 66 basis points as rate hikes get priced back into September. Welcome to the Daily Brief Canadian Macro. I'm Steve. Today we're covering three major developments affecting Canadian investors. Market Mania is tracking bond signals pointing to inflation pressures. Mark Mitchell exposes how Canadian media covers real estate industry claims. And over at the Loonie Hour, the three amigos, Steve Soretsky, Richard Diaz, and Keith Dicker, had pipeline executive John Carruthers on to discuss why Canada struggles to build energy infrastructure. Let's start with what the bond markets are telling us. Market Mania covered what they're calling explosive inflation signals from Canadian bond markets. Their core argument is that bond markets are pricing in significant inflation ahead, driven by a 50% surge in oil prices since February 27th. The 2-year government bond has ripped 66 basis points higher since March 2nd, completely ignoring the Bank of Canada's rate hold. What's interesting here is that September 26 now shows a 65% probability of rate hikes, with December also showing rate hike expectations. Market Mania points out that core inflation has been running near 3% for the past year, though it has to be mentioned that CPI trim and CPI median have been hovering in the 2.3 to 2.7% range for several months before this oil crisis began. And core inflation excludes groceries and gas that are now spiking dramatically. However, this creates a challenging scenario where inflation-adjusted house prices are falling while mortgage renewal costs are rising. Additionally, as mentioned on this channel in a previous episode, the interest rate hikes won't correct inflation caused by oil supply shocks, as supply shocks are typically solved with the production of more oil. Increasing interest rates when the economy is showing signs of obvious weakness may just bring on an even worse economic condition, pouring gasoline on a burning economy. So if bond markets are already pricing in this inflation risk, the question becomes, what are Canadians actually being told about what's coming? Well, Mark Mitchell had some pointed thoughts on that. Mark actually takes an interesting take on Canadian real estate media coverage, specifically calling out Financial Post journalist Lisa Harrapin's interview with real estate spokesperson Sean Cathcart. Mitchell's main point is that Canadian media is captured by real estate industry interests, allowing false claims to go unchallenged. He reveals that Harrapin interviewed economist Benjamin Tal first in the latest news broadcast, who explained that rates stayed high only due to the Iran war and energy crisis. Then let Cathcart follow up by making opposite claims without even challenging him. The Canadian Real Estate Association falsely claimed they predicted the Bank of Canada would hold rates since October 29th, but Mitchell argues they were only right because of geopolitical tensions. What's particularly noteworthy is Mitchell's observation about FOMO tactics disguised as analysis, where claims that interest rates and home prices are at the bottom are designed to pressure buyers into taking immediate action. And understanding why Canada can't build its own energy infrastructure helps explain why we're so exposed to the kind of oil shock that's now driving everything Market Mania is warning about. Over on the Loonie Hour podcast, pipeline executive John Carruthers shared why Canada struggles to build energy infrastructure, drawing from his experience with both failed and successful projects. Carruthers' core thesis is that regulatory approval is insufficient to proceed, and broad public support plus First Nations buy-ins are practically required before construction can begin. Carruthers detailed how Northern Gateway spent $600 million over 10 years in regulatory process fees, only to be ultimately cancelled. Marine spill risk was the primary deal killer, and despite reducing the risk of major spill to once every 15,000 years, public perception of marine environmental damage couldn't be overcome. The reason this matters for Canadians is that including marine safety assessments now requires 180 days of testimony and thousands of pages of documentation. Carruthers noted that the federal government called him directly even when Kinder Morgan wanted to exit Trans Mountain, showing how few executives have the specialized experience to navigate Canadian pipeline politics. After the Carruthers interview, Keith Dicker, Chief Investment Officer of IceCap Management, offered a counter-argument to the rate hike narrative during discussions between the three amigos. Dicker's view is that rising energy costs won't translate cleanly into consumer inflation. Instead, businesses will struggle to pass those costs on, leading to margin compression, layoffs, and broader economic deterioration. In other words, the oil shock may hurt the economy long before it shows up as the kind of sustained inflation that would justify rate hikes. Looking across today's analysis, we're seeing multiple pressure points on the Canadian economy. Market Mania suggests bond markets are pricing in inflation pressures that could force rate hikes despite central bank preferences, while Mitchell argues that the real estate industry's messaging isn't reflecting these economic realities. Carruthers reveals the structural challenges in Canada's energy sector, where projects can spend hundreds of millions over decades without certainty of completion. Market Mania shows bond pricing in September rate hikes, while Mitchell demonstrates how industry spokespeople claim rates are at the bottom, though as Dicker argues the more pressing risk may be that the economy deteriorates before inflation ever gets that far. It's also worth noting that central banks typically don't telegraph rate cuts, as signaling too early can defer consumer spending and become a self-fulfilling economic decline. According to Carruthers, Canada's energy sector infrastructure challenges mean we're dependent on external factors for both the supply and pricing of our energy products, which connects back to Market Mania's observations about oil price volatility driving inflation expectations. Well, that's today's brief on Canadian macro. All credit goes out to the creators featured today. Their original videos are linked in the description below, and I highly recommend checking them out for the full analysis. If you found this helpful, please subscribe, hit the notification bell so you don't miss tomorrow's brief, and don't be afraid to comment here if there's another creator you think deserves a like here. I'm Steve. As always, nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified advisor before making any decisions. Good night.